AP, Beijing, the latest quarter saw a slight improvement in China's economic growth, but it was still among the weakest in decades as the country's Communist Party-controlled government works to reverse a downturn while enforcing anti-virus controls and a crackdown on debt in the country's massive real estate sector. In the 3 months ending in September, the world's second-largest economy expanded by 3.9% over a year earlier, up from the prior quarter's 0.4%, according to official figures released on Monday. The announcement was initially scheduled for last week but was delayed as the Communist Party, which is in power, met to extend President Xi Jinping's leadership term. By appointing a 7-person ruling standing committee made up of his supporters, the party granted Xi complete control. The party's number 2 until last week, Premier Li Keqiang, who supports free enterprise, was removed from the leadership. Despite the surprise positive news, Chinese stock markets closed down on Monday, indicating investors remain worried about the country's development prospects. Shanghai Composite Index, the benchmark for the nation's markets, decreased by more than 2%. Hong Kong's Hang Seng Index fell by an exceptionally large daily margin of 6.4%. Asian marketplaces in Tokyo and elsewhere expanded. Investors and the general public kept an eye on the Congress for announcements of plans to boost the economy or lessen the effects of zero-COVID rules that close cities and disrupt commerce, but none were made. China's trading partners suffer as a result of the most recent GDP slowdown, which started in mid-2021, as the demand for imported food, oil, and consumer goods declines. According to Iris Pang of ING, the improvement is primarily a result of more flexible anti-virus policies that isolate certain buildings or areas rather than entire cities. More lockdowns, she added, are still a significant question. According to Pang, this uncertainty indicates that the efficacy of pro-growth policy would be compromised. To ensure that buyers receive flats, Beijing has made mortgage lending easier and local governments have taken over certain unfinished projects. Regulators, however, who strictly enforce debt ceilings, have driven some smaller developers into bankruptcy and prevented some of their larger rivals from making bondholder payments. Despite increased expenses and public annoyance during the temporary shutdown of Shanghai and other industrial hubs, the ruling party is enforcing zero COVID. At a time when other nations are loosening anti-virus measures, it has erupted into protests in some locations. According to Larry Hu and Yusio Zhang of Macquarie, growth is extremely unequal and underpinned by government spending on constructing roads and other public works while consumer spending is declining. Retail sales growth decreased to 2.5% in September from 5.4% the previous month. Factory output growth jumped from 4.2% to 6.3%. Also on Monday, trade data revealed that in September, export growth decreased from the previous month's 7% to 5.7% when compared to a year earlier. 0.3% of imports increased. According to a research by Capital Economics' Julian Evans Pritchard, the majority of the economy lost impetus last month. It appears that things got worse in October. Infrastructure spending, primarily funded by the government, increased 16% in September compared to 15% in August. Beijing is adopting targeted, careful stimulus rather than general spending, which will take more time to produce results, according to experts. Chinese policymakers fear that excessive expenditure could increase business debt or housing expenses, both of which are politically sensitive.